Today talk again about the ACCA exam prep, management accounting, and we have to calculate the fixed overhead expenditure variance, the fixed overhead volume variance. We have a budgeted of a company make and sell for 1,200 units. The standard fixed overhead cost per unit is $4. And we have the actual results, the actual production and sales of 5,000 units, and the fixed overhead incurred of $17,500. The fixed overhead variances, we calculate it in this way. The fixed overhead expenditure, we have the difference between the budgeted overhead expenditure and the actual overhead expenditure. We have 4,200 units at $4 per unit, and the actual overhead expenditure is higher, so we have a difference adverse, a fixed overhead expenditure variance of $700 adverse. The fixed overhead volume variance is calculated this way. We have the actual production at standard rate and the budgeted production at standard rate. The difference between is the fixed overhead volume variance. The actual production at standard rate is multiplying the 5,000 units with $4 per unit, and we have a value of $20,000, the actual production standard rate. The budgeted production standard rate is the budgeted production of 4,200 units at the standard rate of $4 per unit. So the budgeted production the total budgeted production at standard rate is $16,800. The difference is the fixed overhead volume variance and is favorable. So we actually budgeted less, the actual is higher and the budgeted is less. So we have a fixed overhead volume variance of $3,200 favorable. The fixed overhead volume variance is favorable, and the fixed overhead expenditure variance is adverse. Tomorrow again another exam ACCA preparation for management accounting.